Isn't that fascinating how the collective mind has the memory of a goldfish? Whenever crypto goes down, people just say, buy the dip, it's going to recover. But will it really? It seems like the vast majority of market participants right now have already forgotten how bad a bear market can really be. Now, I don't have a crystal ball either. I do not know where Bitcoin will go from here, but I'm using approaches that historically, statistically did work in the past. And I'm simply just looking at those approaches. Does it make sense to buy a certain dip? Or does it make sense to be rather cautious? I hope you are aware of the situation, but in case you're not, there are bear markets where Bitcoin dropped by 85%. This was in 2024, and subsequently we had a nice rally, but then again, Bitcoin dropped from 20k all the way down to 3.2k. A drop of 83%. And then again, we recovered, but then again, we had a massive correction, this time by 76%. And so there's two approaches to this, right? Either we completely forget about the volatility, we just buy and hold, we don't even look at our portfolio, or we try to time the market. Now, if we go with the second approach, we try to sell before we see most of the sell-off, then we have to think of an approach that might work in the future. Now, here's a very straightforward approach, a moving average. So we could be buying whenever the price is above the moving average, and we could be selling or be in cash or bet on falling prices whenever we are below. So we are long over here, we buy Bitcoin, and then we sell when we are below. And while the approach is not perfect, it seems to at least partially protect us during bear markets. So this here is a 47% drop that we would have not been in the market, while the overall bear market was of course way more severe with a depreciation of 83%. But at least partially we protect ourselves and we can buy back, in this case, double the amount of Bitcoin after the bear market. So you see here, this white line, that's the 200-day moving average. So according to that strategy, we would still be buying the dip, because we are still above and things look bullish. Now there's a problem with this strategy because we don't really know how well did this approach actually work in the past. And we also don't know, is it really the 200-day moving average that's best? Because there's a bit of a problem with the approach. It is somewhat slow, as in we've already looked at the bear market in 2019. We didn't sell over here, right? We sold over here. So we already went down by more than 50% before we start selling. And the same argument could be made for buying the bottom, right? We're already up 46% before we buy. And so maybe 200 days isn't the best. Maybe we should go down in the duration. Once we reduce the duration, we see how the moving average gets closer and closer to the price. So now we are starting to buy in much earlier. We take more of the bull market. And it seems like it's also great that we're selling much earlier. As I'm reducing the length of that moving average, we're now selling already over here. This is not a 50% drop anymore. So maybe the 100-day moving average for that strategy is better than the 200-day. But where's really the line? Should we potentially take the 80-day? Should we potentially take the 60-day? Or even go lower than this? 40 days, 30 days, 10 days. What is really the best way to protect ourselves in case we sell off? And what's the potential problem if we take a moving average duration that's too close? The issue when we're too close with the moving average is that we get a lot of bad signals. As in, we might end up selling low and then buying back in high again. So for example, let's take this case here. We are selling on this day just in order to then buy back in again when we are above. So the Bitcoin price went up by close to 2%. We've lost 2% of our portfolio. And this happens time and time again. Over here again, we sell at this price. And then where did we close above? Over here, we have lost 2.8% of our portfolio. So there is an issue that when we get too close with the moving average, that we get all of these bad signals, we end up selling low and buying in back high again. So it's a balance between the bear market protection, so we sell when things turn around, and the potential bad signals that cost us money. The question is, where is the ideal balance here? Where should we set our moving average? At 200 days or at 10 days or at something in between? And so to answer that question, I have used Microsoft Excel. So we've got data that starts in 2018, and I've backtested all the moving averages from the 2-day up to the 200-day. Now I've backtested the simple moving average. I've also backtested the exponential moving average. And while this is the results in table form, here we've got the same in a chart. And I think this shows the story quite clearly. On the x-axis, we've got the duration of the moving average. On the y-axis, we've got the annualized performance. So the geometric average of the performance. The black line here in horizontal, that's what buying and holding would have gotten us throughout that time period. So if you have a very short moving average, one that's below 30 days, we tend to have a lot of bad signals, and that then destroys our performance. The shorter the moving average, the more performance destruction we get. We then see better and better performance up until a certain point. Once the moving average is too long, then it's not reactive enough anymore, and then it approaches just buying and holding. Now the exponential moving average, that's here in red, it tends to underperform the simple moving average. So we can just focus on the SMA, and we see now that the best moving average duration historically was the 120-day SMA. It's not that important that we take the 120-day SMA. We could also take the 110 or the 130, but 120 tends to perform pretty well. What I also like about this backtest is that pretty much any moving average is doing better than buying and holding. So timing the trends does make sense. Timing the trends does give us more performance compared to just setting and forgetting, compared to just buy and holding. So following the trends is a winning strategy. While there is a case to be made to just buy and hold and dollar cost average in, while this is a straightforward money-making strategy, I believe it's not the optimal strategy. I believe that following the trends and selling sometimes when we are bearish does make sense. Now, the 120-day is the best. And so let's plot that on the chart. This is what we get. And this now gives us the answer to whether or not we should buy the current dip. The answer is no, we probably shouldn't. There is a risk. It's not 100% safe. We have seen failed signals in the past. There's a risk that now we see a deleveraging in crypto again, that now we start to see a sell-off again. Again, I do not have a crystal ball either. I do not know where Bitcoin is going from here. I'm just simply trying to use an approach that historically worked very well in the past, that did much better than just buying and holding. And so I'm managing my risk. I have sold a lot of my Bitcoin. I'm okay if BTC is now crashing more. Now, how much better is this approach actually? Again, this is annualized, right? This is the performance we got historically per annum. And so this was the Bitcoin price development during the time. And here is the return of that moving average strategy. We are betting on rising prices and on falling prices. So right now, as we fell below the moving average, we are shorting. We are betting on falling prices of Bitcoin with that simulation. This is a linear scale here. We can also have a look at this on a logarithmic scale. And again, we see how constant this strategy outperforms just buying and holding Bitcoin. We can also modify the backtest. We can just have a look at what happens if we just get into cash. That's the return we get, right? Whenever we are below the moving average, we just go sideways and we don't gain anything. I also have not included any interest rate gains or something like this. It probably won't move the needle that much. Still, it tells us how the strategy can protect ourselves against the bear markets. And again, there is a risk that every now and then we get a bad signal that does cost us money. But there's the upside of not losing 70 to 80% during a crash like this, right? We protect ourselves here from 65% purchasing power destruction. Yes, there are a few failed signals in here as well, right? So maybe it's not 65, maybe it's only 60%, but you do get the idea, right? There's more than double the amount of Bitcoin that we can buy back after a crash like this. And I'm okay to get those occasional losing trades every now and then, if in case we do now suddenly turn around, in case the market cools off again, that I can still sleep very well at night. I think having less volatility is also a benefit in itself, right? The maximum drawdown from top to bottom is not 70 or 80% here. It's a much more constant growth curve. And that is what we should all strive for, right? It's not just about outperformance, it's about outperformance risk adjusted. We want to reduce our risk while at the same time increasing the performance. Now, isn't it fascinating how the asset selection itself seems to be rather a secondary problem, as in there are market phases where everything is going down at the same time. And then there are other market phases where most altcoins tend to go up. There's just so much correlation within crypto. What we see in green, that's the market cap of the altcoins that are not in the top 10. What we see in orange is the market cap of Bitcoin. What we see in blue is the market cap of Ethereum. So this is just relative performances over time. They all go up and go down at the same time. Now, what's important to note here, though, that this is a comparison of market caps. It's not a comparison of prices, because actually the small altcoins tend to perform much worse than the market cap implies. This here is the performance of the smaller altcoins, so from rank 800 to 900 in the last year. There are a few outperformers. So there's 1, 2, 3, maybe 4 altcoins that did roughly 100% and a bit more. Now, why am I talking about the 100% cutoff? Because that's how much Bitcoin made in the last year. So that should be our benchmark. All the altcoins that did not return 100% in the last year did much worse. And that's obviously the vast majority. We are seeing here 100 alts and only 4 did better than BTC. So really, trading altcoins is incredibly risky. Now, why do the altcoins perform that poorly? It's because of tokenomics, or in other words, the supply of many altcoins grows very quickly, much faster than the demand, which then depresses the price. There's all kinds of different flavors of token inflation. There's the constant inflation, like over here for ApeCoin. There is the cliff unlocks, as over here with 1inch. Or there's a mixture of both. We've got constant expansion plus cliff unlocks. That's now here as an example, XE Infinity. And so because of that increasing supply, just holding a broad basket of altcoins is a very bad idea. This is a good idea in the stock market. It's not so good of an idea in crypto. Have a look at what happens with most altcoins. This is ApeCoin over time. This is 1inch over time. And here is XE Infinity over time. When the supply grows constantly, the price tends to go down because the demand has a very hard time catching up. And so I personally generate my alpha, my outperformance over buying and holding Bitcoin with exactly that strategy. I still like to hold Bitcoin, but at the same time, I'm also betting on falling prices of especially the weaker altcoins that expand quickly in supply. I made many videos on the topic, but actually you don't have to watch all of this. Just have a look at what kind of outperformance can be achieved. What we see here in orange, that's Bitcoin. And what we see in green, that's going long Bitcoin and short ApeCoin at the same time. So we're betting on falling prices of ApeCoin. At the same time, we're betting on rising prices of Bitcoin. And then we get this nice performance, which is way steeper compared to what just buying and holding Bitcoin provides. Here's Bitcoin versus 1inch. So again, massive outperformance, 4,400%, while just buying and holding Bitcoin during the same time period returned less than 400%. And over here, we've got Bitcoin relative to XE Infinity. Now, this is just a few examples. I'm actually following this strategy already for the last 4 years. And had I just dollar cost averaged into Bitcoin, I would have gotten this performance here in light gray. But because I also bet on falling prices of highly inflationary altcoins, I got the performance here in black. Now, very often, the first reaction that I get when I describe this strategy is that this is too complicated. Just tell us the next big altcoin that makes a 10 or 100x and everything is fine. But I don't think it is. Because again, just have a look at these smaller altcoins in the last year. There is a 90+% likelihood that you're going to do worse than Bitcoin. And even if you pick an altcoin that's doing better, once you diversify a little bit, the portfolio is likely going to go down. Again, because the insiders constantly cash out and dump on the average retail investor. This is an unpopular story within crypto because it doesn't sell as well, right? Most influencers, they actually get paid by the crypto project in order to promote the project. And so they just say this is the next 10 or the next 100x altcoin. And then of course the insiders, they dump on retail, the altcoin actually crashes and does not do the 10 or 100x. And so I just like constant outperformance over trying to find the one lottery ticket. Now in the end, it's actually not that complicated to set up those relative valuation trades. There are only 2 videos that you have to watch. Here's the first video, using perpetual futures on Hyperliquid. And here is the second video, risk management with relative valuation bets. Once you've watched those 2 videos, which is in total 1 hour of content, then you know exactly what to do in order to get this performance or this performance or this performance. After you've watched those 2 videos, I will share my favorite trade with you. And those favorite trades have still a lot of token inflation ahead. The 3 examples that we looked at, they have already inflated. Most of the supply is already circulating. But my favorite trade still has a lot of token dilution in front of it. So it's likely going to continue to underperform. I'm so confident in that particular trade that in case you do not make money with that trade after holding it for 1 month, then I will refund the premium membership fee to you. So you don't pay anything for premium if that trade doesn't make you money. So the whole idea is that premium pays for itself. You sign up, you watch 2 videos, you open the favorite trade, and again, if you don't make money with that trade, you will get the $125 back, no questions asked. A link to premium should pop up directly here on the screen. Just click on that. It will lead you to the website. If it's your very first time here, feel free to subscribe. I publish here regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. Cheers.